Well, good evening, everyone. Welcome to the second virtual Stockslam. It is an absolute pleasure to be here back again as your host after our last event in February. We slightly underestimated just how popular the slam would be. And in a virtual sense, we had viewers lined up around the block hoping to get a seat. Fortunately, this time, we've tripled our capacity to 3,000 people, and hopefully that will be enough. Now, talking the last event, one of our viewers, Alan McBride, created a dummy portfolio to see what would have happened if he'd invested £1,000 in each of the 10 picks. And somewhat remarkably, the whole portfolio is up 11% in the last 7 weeks. Although, to be fair, it's been a bullish period in the markets. More impressively, Halford's gained 42.2% and Renault is up 34.5% since then, which puts them way ahead of my portfolio. Now, at the other end, only Caledonian Mining and Italian Mining have dropped. And even here, the falls are pretty low at around 4%. Which, I think that's pretty good. But you can see the connection there with the mine companies. So I'd just like to say, well done, Dio Hare and Paula Scott. You can definitely come back and present again. Now, for tonight, we have an excellent lineup of speakers. And for those new to the Slam, I'll quickly explain how it all works. So each presenter is given 3 minutes to pitch their idea, which tends to pass rather quickly. And then we allow another 3 minutes or so for questions from the audience. And shortly, Thames will explain how this works. And after that, I introduce the next speaker, and we start the whole process all over again. Now, all in all, the slam should be done and dusted in about an hour, and then we can all relax. Now, one thing I'd just like to mention is that everyone presenting here tonight is doing so in a personal capacity. So this means we're not giving share tips or advice. These are simply investing ideas we're happy to share. We're not doing this as a professional. So to avoid any doubt, it's best to assume the presenters hold the shares they're pitching, and they're talking their own book. Finally, I'd just like to quickly thank piworld and Stockopedia for their welcome assistance. None of this would be possible without them. In addition, piworld are recording this slam, and a video of the event will be available before the weekend. So don't worry about missing anything or writing it all down. You'll be able to check the recording. And now, Tamsin, would you like to explain how people can ask questions?
So to ask your question, click on the question mark, which is on the right-hand side or at the top on a mobile or device, and type your question there.
That's great. So, without further ado, we'll start with the first slam, which I'll be doing. So, I don't know if you want to start the timer, Tamsin. So, tonight I'm going to be talking about Micro Focus. Now, this is a global IT services business. It's been public for about 15 years. But before I get into all those details, I want to make one thing very clear. This is a high-risk investment opportunity. These shares have been falling for over 3 years, and you can see it on the share price chart. And there's been at least one false dawn in the past where the shares doubled before continuing to decline. Now, at this point, I don't actually have a position on Micro Focus, but I did choose it for the Stock Slam, so I'd have a reason to take a good look at the numbers. So let's get the negatives out of the way. The gorilla in the room is the disastrous merger with the Hewlett-Packard enterprise software business about 4 years ago. This was a massive $8.8 billion merger and the fifth big deal in 3 years. It quickly became obvious that management had totally overextended themselves. And the CEO, who was parachuted in from HP, was way out of his depth. And eventually he and the chairman at the time got the boot. So over that period, since the merger, the shares lost more than 80% of their value from late 27. And even now, sales are still declining. Clearly, the company is massively damaged. A direct consequence of this is that Micro Focus is loaded with over $4 billion worth of debt, compared to a market cap of just less than £2 billion. And barely a dent has been made in the debt pile, and I suspect a rights issue will eventually be required to fix it. However, no debt matures until 2024, so there's enough breathing space there to kind of lighten that debt load. And finally, I should just mention a Texas jury has ruled against Micro Focus in a patent litigation case with damages set at $172.5 million, and they could go higher if the judge decides so. Micro Focus is appealing and asserts that the accusation is baseless, but then they would say that. Fortunately, there are a number of positives to get excited about. On an underlying basis, the company is profitable with an adjusted EBITDA margin of 39.1%, down from 40.7% in the previous year. And the revenue decline year on year was 10%, which is not bad, considering we've just had a pandemic. Now, management see revenue stabilizing by 2023, and that should be helped by the 72% of revenues that are already contractual and recurring. And in addition, you've got cost reductions that should improve the bottom line and allow the board to generate around $700 million worth of free cash flow annually that their turnaround plan requires. But talking about the board, it's been a real revolving door situation, with the CFO, CEO, chairman all changing places. Most notably, Stephen Murdoch, who is now CEO, was CEO before the HP merger and then returned to that role 3 years ago. And the chairman at the time, he took a bit longer to kick out the door, but he left a year ago and was replaced by a guy called Greg Locke. And this guy, Greg, has spent £2.5 million worth on shares around the lows in 2020. So he is clearly convinced this business has a future. And now on the CFO roles, well, they're looking for their third CFO in as many years, and hopefully they'll find someone with a bit of sticking power. Anyway, the company is about 1 year into a 3-year turnaround, and it seems that tailwind is picking up. Apparently, customer demand, start to finish, customer demand for mainframe application modernization solutions is never stronger than it was last year, and the pandemic just introducing delays into the process. And of course, half the revenues come from the US, which is a recovering economy, so that should be very beneficial. Finally, I should just say, Micro Focus has signed a new deal with Amazon Web Services, the theory being that Micro Focus can help customers with legacy applications move them into the cloud. Now, this has been a bit of a kicker for the shares, and it looks like it could be a big deal for both of them. And with that, I guess I'll take questions.
Very good, Damian. So how important is Micro Focus's software to customers? Is it sticky or are they being disrupted?
What they're really trying to do here, of course, you've got big companies that have a lot of legacy systems, the ones that have been around for decades essentially. And what Micro Focus is doing is helping them modernize them, bring them into the cloud, essentially take them into the future. So of course, I think it's not so much that they are introducing their own system into these customers and they keep paying for it year after year. It's more that if you bring Micro Focus on board to deal with one of these projects, you're talking about a lengthy, long-term project that will, perhaps extend throughout a large-sized company.
And what's the reason for the large difference between the market cap and enterprise value? It feels overpriced at a $4.83 billion enterprise value.
Yes, absolutely. I mean, they've got $4 billion worth of debt. Now, they've got essentially, it's a structured debt, and they don't have to make any repayments on that debt until 2024. So obviously, they have some visibility over that debt, but there's no doubt about it that the debt load they have far outshadows their actual market cap of equity.
And why has the share price been increasing since November?
Well, I suppose there are a couple of things. I mean, one is, of course, general recovery from the pandemic, kind of a switching from growth shares into value shares has obviously helped. Secondly, Micro Focus has 50% of their revenues from the US, and given the stimulus that's occurring in the US, and now that obviously Biden's in power, I think that's obviously a tailwind for them. And C, I think the recent notification of the AWS contract has definitely helped. And maybe the last point might be that the change of chairman, because the chairman who was there left, a year ago, and I would suggest that there's probably the change in the board has kind of helped drive a tailwind to the share price.
And how do you find the debt mature date?
Well, as I was saying, as they said in their reports, the next date is 2024. So that's, they've got 3 years to at least chip away at it.
And the sale of Seuss looks a bad decision, approximately $2.5 billion around 3 years ago. Will it now be listed for approximately $8 billion? Poor decision, as very little was used to pay down debt.
No, there's definitely a question there. I mean, whether they will have to raise more cash by an equity issue, or kind of come up with some other way, essentially, of dealing with this, I don't know, but that's quite likely, I'd say.
Why are they paying a dividend given the net debt? It doesn't make sense.
I'd say it's pretty much a token dividend, and I guess what they're trying to do here is send a message to the market to say, look, we have confidence that our turnaround plan is working, even though it's only 1 year into the 3-year plan. And I guess they're trying to say, look, we are comfortable with our debt profile, and we feel we can pay some out of this free cash flow we're generating.
Thank you very much, Damian. We've got lots more questions, but we've run out of time. Back to you.
Okay, well, thank you for the questions. As I said, I haven't actually invested in Micro Focus yet, but it's certainly on my radar. Now, coming up next is Keelan Cooper, who is going to talk about Tharisa.
Yeah, hi everyone. Tharisa is a London and Johannesburg listed platinum group metals and chrome producer, operating the Tharisa mine in the highly prolific Bushveld complex in South Africa. So the Bushveld complex hosts 2/3 of the world's platinum group metals and chrome resources. So this is a great region to be in as the world's only co-producer of both PGMs and chrome concentrates. The Tharisa mine is a low-cost, long-life mine, which has 14 years remaining as an open pit operation, and at least a further 40 years as an underground mine. So moving on to current production, in 2020, the company produced 142,000 ounces of PGMs and just under 1.35 million tons of chrome. The company has set a near-term production target of 200,000 ounces of PGMs and 2 million tons of chrome annually within the next 2 years. So in terms of market dynamics, it's really a great time to be producing more PGMs. PGM prices have rocketed over the past year due to a significant rise in also catalyst demand, which has come off the back of more stringent environmental regulations aimed at reducing harmful emissions. Platinum prices have almost doubled since their 2020 March lows. Rhodium and iridium prices are at all-time highs, and palladium prices are moving steadily upwards once more. The supply side dynamics for PGMs are also very favorable. There were major supply issues in 2020, primarily due to mine closures in South Africa as a result of COVID-19 lockdowns. Recently, there has been another supply shock. In February, Norilsk Nickel, the world's largest palladium producer, announced that 2 of its largest mines had experienced flooding issues and operations would be temporarily suspended. These issues are expected to see a supply shortfall of over 700,000 ounces of PGMs this year. This could be more if operations aren't resumed by June. So when you consider that the platinum and palladium markets are already in a supply deficit, with rhodium in a severe supply deficit, the market conditions for PGMs are arguably in their strongest position they've been in for decades. So moving on to the financials, Tharisa generated $406 million of revenues and over $113 million of EBITDA in 2020. This was based on an average PGM basket price of $1,704 and a chrome price of $140 per ton. The company currently holds a net cash position of $4.8 million. So Tharisa has one of the most favorable prill splits amongst PGM producers globally. In a recent investor presentation, the company disclosed that the current spot prices for its average PGM basket had reached over $4,000 and also $180 per ton of chrome. Based on current production guidance and costs remaining stable, if these prices were to persist for the remainder of the year, you'd be looking at a company able to generate earnings equivalent to its current market cap. So there's still considerable upside potential from the current share price. The brokers covering the stock are seemingly bullish as well. Peel Hunt and RenCap valuation models show that Tharisa has one of the highest potential share price upsides based on current PGM spot prices, with an estimated 157% upside. So yeah, that's my pitch, and thanks for listening, everyone.
Thank you. And why Tharisa as versus Sylvania Platinum?
That's a good question. Sylvania Platinum is a great company, but I think in terms of near-term production growth, as mentioned, 200,000 ounces within the next 2 years, and they've got a great prill split as well in terms of rhodium production at the moment. There's also more upside potential from future projects. It's got a great interest in Zimbabwe, potentially 25 million ounces over there for its interest. It's got options on iron and manganese assets also in Zimbabwe. So yeah, I just think more upside potential for Tharisa, and it's also going to be investing in refining activities. So its margins will only be heading upwards in the next few years.
Thank you. And why are so many institutional investors selling their positions out of Tharisa?
Yeah, this has been happening quite recently, and I think that's probably on the back of Tharisa having tripled the year, and some institutions might want to rebalance their portfolios accordingly. Yeah.
Thank you. Are they looking at any other mines?
Yeah, so they've got their interest in Zimbabwe, and the management have been quite optimistic about the potential for diversification and acquiring assets elsewhere, and for other metals as well.
Thank you. And are there any concerns with their Cyprus headquarters?
Not personally. I mean, I haven't looked into that too much, but a lot of companies have domiciles in countless places now for tax reasons and whatnot. So, yeah.
The PE is low as an enterprise value to EBITDA. Why is the price to free cash flow multiple so high at 217 times? What is the forecast to be over the next 12 months?
So those figures need to be updated, actually. The price to free cash flow is much, much lower than that. And the PE, if you look at current spot prices, taking that into account, is less than 3, actually. So they've got an update in May. H1 results will be released then, and they've got a Q1 update next week. So once the audited financial figures come up in May, you'll see that fall quite dramatically, I believe.
Thank you. And do you see the recent director selling as a red flag?
No, I think it's profit taking again, and management have held through for quite a few years now, so it's fair from their perspective.
Thank you. And given the level of dividend cover, which is circa 5 to 6 times cover, why is the dividend so low?
Yeah, so at the moment they pay out 15% of profits, of net profits after tax, and obviously this year the profits will probably more than double. So you can assume the dividend will go up in line with that. But the management has also discussed the potential for share buybacks and increasing the dividend, although I think increasing the dividend will be the preferred measure of returns for shareholders.
Thank you. And is the company exposed to one-off country tax?
Yeah, so I think this is probably the main risk with Tharisa. It's the chrome tax, which has been proposed by the South African government, which we haven't heard anything of since, I believe, October last year. I mean, independent assessments have shown that the risks outweigh the benefits for this, and if South Africa decided to go ahead with the chrome tax, it might violate international trade treaties, and China might retaliate. So it remains to be seen whether they implement it. But they've considered it twice in the past and not gone ahead. So we'll see what happens with that. But that is a risk. But again, 20% of their earnings last year came from chrome, so it's not going to have a huge impact on operations.
Thank you, Keelan. It's provoked loads of questions, but we've run out of time. Thank you very much. Damian, back to you.
Cool. Thank you, Keelan. That was good. I mean, I've got a holding in Sylvania, so I know the area. And obviously, Tharisa has its benefits by having its own chrome mine, one relying on host mines, so that's definitely positive. So yeah, definitely want to look at. So next up, we have Cockney Rebel with John Menzies.
The stock I've got for you today is John Menzies, which is the aviation company, aviation support company. I'll say straight away that I've got a holding in this. I'm biased, so do your own research. This is only my idea. The first thing to say is they've got the bad bits is that they've got 335 million of debt and they've got negative assets. So if you're into asset plays where you want asset-backed investment, this probably isn't for you. But if you put that aside, the debt is actually fell in 2020 from 390 million to 355 million in what was the toughest year ever for aviation. They've had 149 million operating cash flow in 2020 and undrawn banking facilities of 142 million. They used to have two divisions, which was the ground support division, and they had a distribution business. They've sold the distribution business for 75 million cash in May 2019, and now they're a pure aviation play. The CEO left after the disposal in March 2019 and was replaced by Giles Wilson, who became the new CEO. And also non-executive Philip Jonig became executive chairman. 2 months later, Jonig bought 1.2 million shares at 390 pence, which is 4.7 million pounds worth, which is sort of a big vote of confidence for me. He's got 15 years experience in the aviation business and was executive president at Swissport, which is Menzies' main competitor, which I like because that looks like he could steal a lot of business from them. 1 month later, he had won contracts in Glasgow, Edinburgh, Gatwick and Heathrow airports with 4 different airlines. They're winning contracts regularly with the likes of Wizz Air and other airlines, and they've made an acquisition in Pakistan. I don't think you make acquisitions in Pakistan if you're not pretty confident you've got plenty of cash and cash flow coming down the line. They've slashed costs and shed 40% of the workforce, which means margins should increase dramatically going forward, being this is a people business. They've had no need to raise money at all, and so they've not diluted any of the shares. While the passenger side of the business is down hugely, the cargo side is up really strongly. They do ground handling, refueling, freight forwarding, passage handling and baggaging. They're reducing services to small uneconomical airports and focuses on the big airports. They expect growth to be 15% this year and expect 4% growth per annum for each year of the next 8 years. Berensberg are forecasting 21% PEPS this year, 37p next year, and 40p for 2023. The current share price is 350p. The PE is 16, falling to 9 for 2022, and falling to 8.3 for 2023. The CFO just bought 40,000 shares at 2.99 and 50,000 shares in November at 161. Big vote of confidence. I've run out of time, so I can't do the last little bit or do me Tom Jones impression.
Thanks, Richard. So the first question is, what is your target valuation?
Going back about 3 or 4 years, these were £7.50 a share. They've had hardly any dilution. They've not had to raise any funds at all. The sales back then was around 1.8 billion, I think. Some of that was the distribution business. So I think their sales for the airline side was probably about 1.5 billion. They're forecast to do about 1.1 billion sales this year. So there's scope to get back, another 400, 500, 600 million and get to higher sales. They're on higher, they're going to be on better margins than they were back then. So I think the 750p target that they were is a good target price, even though they've had about 10% dilution, possibly higher. There's currently the airline business is up in the air, so all airline businesses are up in the air. So the actual confidence in these sort of companies is low. So obviously the valuations are low, and that's one reason why I think it's possibly got poor sentiment at the moment still, but could have great sentiment going forward.
Thank you. Their market's highly competitive, low margin. Is there not a risk of airlines taking this work in-house like Jet2 have done?
I don't think there is. I think that it's very fragmented across all the world. There's lots of little small companies doing these type of things. The problem with that is when you're a small company trying to do this in various airports across the world, your costs are far higher than being one large business that can do this across the world. And so I think it's a matter of size. They've got great size. They're the second biggest. Them and Swissport are the biggest going. So I think there's not an awful lot of chance of their business being chipped away. I think if anything, they're going to be taken over in a takeover at some point. It's been touted for a long time that they'll be taken over, and I don't know how many years that this has been said, but now they've got rid of the distribution business and they're a pure play airport support business, then I think the chances of them being taken over is even far greater now, and I don't see them being chipped away at by the small companies that are going around the world.
Thank you. And why the big difference between operating profit and free cash flow?
I think currently a lot to do with the way things are up in the air at the moment. I just think you've got to accept that all airline business at the moment are completely up in the air. They've gone through, I think this has got to be the industry that has the worst time through this disaster than any other industry. Maybe hospitality has done that as well. So I think what you're looking at numbers at the moment are going to be nothing compared to what the numbers are going to be like in a year or two's time. So for me at the moment, I wouldn't call it a wing and a prayer. I'd say this is an investment backed on faith that the management knows what they're doing, and going forward, it's going to be a totally different picture in 2 years' time. I think their cash flow is going to increase and their debt's falling. So I don't think there's issues there at all.
Thank you. And a quick yes/no. Are there any important contract expiry dates coming up with airports?
Not that I'm aware of. I can't say I've really looked into the expiry dates of those. It's something probably I should have a look at, but there's nothing that I've actually seen that puts an alarm bell. They're actually winning contracts. They've just recently won contracts for Wizz Air in 2 places in Bangladesh and up in Edinburgh. So they're actually outrunning contracts. If anything, contracts are increasing rather than decreasing. And I don't think there's any large ones that I've noticed, but that will be something I'll just check on.
Thanks, Richard. We've reached the end of time, but there are more questions. But thanks very much indeed.
That's all right.
Damien, back to you.
Cool. Thanks, Richard. Excellent presentation. Certainly does look good. There's a nice bowl on the chart I see there with Menzies. Although the only problem I find is that whenever I see their name, I think of newspapers. So maybe they should think of changing it. Anyway, come up next is Mark Simpson with finnCap.
Thanks, Damien. So, hi, everyone. Let me start by saying this is the second time that finnCap have actually stolen my thunder. About a month ago, we were going to publish a write-up on the company, on our new small caps life Substack, saying how strong the trading we thought it was. However, the company came out with an unscheduled trading statement saying much the same. And this morning they beat me to it as well by issuing a further ahead statement. So this is a company we probably all know a bit from reading its stock research, but perhaps given the slow reaction to the head statement this morning, it's still below the radar of quite a few investors. For those who aren't aware, it listed into 2019 at 28 pence per share, and it provides nomad brokerage and research to mainly AIM companies, plus financial and mergers and acquisition advice to listed and unlisted companies. Unlike many of its competitors in this space, it's been growing revenue for the last few years. If Sam could highlight the revenue line on here, you'll see the graph is going up there. Last year, it invested in new offices, people, and systems to continue that growth. Today, the company said that due to further strong trading in March, they expected income to be up 83% year on year to 47.3 million. Progressive have a new note out this morning, and they've upgraded the forecasts. We can see that they're likely to have 14.4 million cash at year end, which is about 25% of the market cap. And they've got 4.4 pence of EPS, which puts it on around 7 price earnings of 7, which is very cheap for a growing company. Following the advice of ice hockey legend Wayne Gretzky to skate where the puck is, not where it's going to be, then we can see that the figures here in the Stockopedia stock rank are going to rise significantly when these forecasts and the future trading is reflected in the stock rank. I expect both the value and the quality ranks to go up quite a lot, and this will undoubtedly be a super stock when those are reflected in here. Progressives say that this that they're being conservative on the EPS here because of the possibility of bonus costs being paid, but finnCap actually have pretty good cost control compared to other listed competitors here. The management own a reasonable amount and therefore are careful on costs. So we could see this beat the Progressive EPS figures and be even cheaper. Where Progressive are certainly conservative, I think, is that they're forecasting only a 1 pence dividend, but with a 0.5 interim dividend paid and a 30-70 split dividend policy, I think 1.5p or 5% is more likely. There's plenty of growth opportunities here through acquisitions and also just taking market share. All my time's up. So, and I think that that the price earnings of 7 and with a quarter of the market cap in cash, this is just too cheap for a growing company.
Thank you, Mark. First of all, for clarity, do you own shares?
Yes, I do own shares in these.
Great, thank you. Operating expenses are very high compared to revenue, which means this is a thin margin business and relies on volume. What do sales volumes look like?
I guess that you get in today's RNS, you get the split of where the different areas are. So they make money through doing effectively placings and IPOs. They make money through like stockbroking. So that's doing market making and things like that. And they also have retainers. So the retainers haven't been growing because the client numbers are fairly static. But with the amount of sort of business that's been done, in the current markets with IPOs and placings and things like that, they've done pretty well. And with market activity increasing, they've done very well on the stockbroking side as well. So it's a sort of two-pronged growth there.
Thank you. And what do you see as the biggest risk with finnCap?
Ooh, I mean, clearly the risk that's being priced by the market is that this is an exceptional year, that the current appetite of investors for placings and being willing to blind to placings, being able to support IPOs will wane. But I think you also see this valuation across the market. So there's kind of quite a few stocks have stretched valuations. So it doesn't seem logical to me that you have this mismatch between the market pricing in a return to normal conditions within finnCap and its equity raising arm, but also sort of simultaneously pricing other stocks that are supported by this activity quite highly. And also, I think we're only just starting to see the mergers and acquisition side. I think that will, sort of grow as the market grows. So even if IPOs drop off, the mergers and acquisitions is likely to remain strong for the next few years.
Thank you. And what are you anticipating they're going to do with their money?
Well, I'd like them to do acquisitions. I think they could buy something like Arden, which is a sort of slightly subscale business in the same area, currently trades at a discount to net tangible book value. And, if they bought something like that, they could strip out costs, they could retain teams, they could grow clients, and they could there'd be great synergies there. I think there's also sort of smaller unlisted companies in this space, and I expect them to be a consolidator and a builder of business. And I suspect that although they are paying a dividend, I suspect some of that cash is going to go to support further growth in that area.
Mark, thank you very much. There are quite a lot of comments about the illiquidity and the spread, but we've run out of time. But thanks very much indeed.
Thank you.
And I'll pan back to Damian. Damian, over to you.
Yep, thanks, Mark. No, that's very good. I quite like finnCap, although I got a bit of a bone to pick with them after they placed the shares in Best of the Best the other week at a rather hefty discount. And of course, you either think they could have done a better deal, but hey, what can you do? Anyway, next up, we've got Lilian Nandi, who's going to talk about Ashtead.
Hello, the company I've picked straight out of the bag of goodies of Santa Claus's bag is Ashtead. It's got the ticker symbol AHT. It's listed on the main market of the London Stock Exchange. It's a large international rental company with a market cap of 20 billion, average trading daily volume of about 800,000. It's in the FTSE 100. It operates in the UK, USA, Canada, trades under the brand name Sunbelt Rentals. It provides equipment for hire to various industries, traditionally focusing on the construction industry, but now targets a whole raft of industries, including healthcare, hospitality, pharmaceuticals, entertainment, retail, oil and gas, etc. Equipment on hire include pumps, ground protection, heating, cooling, forklifts, etc. It has about 19,000 employees, 700,000 customers. That's about 35 customers per employee. It's got about 1,000 stores, about 778 stores in US and Canada, about 200 in UK. Last year, it said its annual revenues were about £5 billion and annual operating profit about £1 billion. Stockopedia gives it a high stock rank of 90 and classifies it as a high flyer. Let's talk about figures. I don't profess to understand much about figures, especially with an audience like this. Nevertheless, here goes. It does allude to a strong balance sheet at a recent webcast in March. It did not take any financial assistance from the government during the pandemic. It managed to arrange its finances so that had record cash flow in the last 9 months. It pays a small dividend, which is well covered, though essentially it's a growth stock. Risk factors may be the cyclicality of some of the products, the need to be especially aware of safety issues and the environmental factors. So what do I like about this particular share? Well, firstly, I feel the share has an inherent strength and resilience about it, with over 19k employees, over 700k customers, and it was founded in 1947, floated in 1986, so it has established longevity. It's quite active, ambitious, and acquisitive. In 2006, by means of various acquisitions, it became the second largest rental company in the US. In 2014, it made its first foray into Canada via an acquisition, and it has since made a number of other acquisitions in Canada. It's got a foothold in traditional industries like construction, and it also looks at new industries such as data centers, streaming services, etc. It combines the old with the new. Secondly, it's in the right place at the right time in terms of big external support, meaning recently Mr. Biden has announced a $2.3 trillion package for infrastructure spend, and one feels it will benefit from this. Last but not least, the proof of the pudding is in the eating. its share price has a track record of performing. In the last 5 years, Ashtead has gone up over 420%. Nasdaq has gone up over 180%. 2 years, Ashtead has gone up over 115%, Nasdaq 70%. Year to date, Ashtead gone over 29%, Nasdaq up over 6%. To conclude, although I'm not a super forecaster, I believe Ashtead is worthy of consideration for the future by my fellow investors. Thank you very much for your time.
Lilian, thank you very much indeed. So, question here, given that it's an equipment rental company, the valuation looks quite full. As you alluded to, it's a cyclical company. So what will be the catalyst for an increase in the share price?
Well, it deals in construction, and that part is cyclical. But however, it has other interests as well, as I sort of mentioned, like in healthcare, hospitalities, pharmaceutical, entertainment. It's recently sort of bought some business in Canada which deals with streaming. So I think that offsets the cyclicality of some parts of the business. So I think the catalyst is very much that it's very much in a targeting a whole range of industries and sectors. And, some parts are cyclical and some parts are probably not non-cyclical.
And why do you think it's a growth play?
It's a growth play because if you look at its history, really, to be honest, 5 years gone up over 420%, Nasdaq over 180%, year to date 29%, Nasdaq over 6%. So if you think about it, Nasdaq is thought of as the growth index of the world, but it is outperforming the Nasdaq. So therefore, I think it is very much a growth play.
Thank you. And who are the competitors to Ashtead?
There is a competitor called in the United States called United Rental. Ashtead, I think Ashtead derives most of its money from the United States, something like 85 to 90%. So if we look at the competitors in the United States, probably its first competitor is United Rentals. I think that has about 15% of the market, where Ashtead has about 10% of the market in the USA. And so, I think, and I think about 60% of the market is full of just fragmented, just sort of small fragmented businesses. So therefore, Ashtead has got room to grow, even though it has competitors.
Thank you. And do you know how much exposure it has to the US infrastructure bill?
I don't quite know that, but having said that, when I looked at their annual reports, it said it gets about, I think, 45% of its business or something like that from construction and 55% from other parts of its business. So it's got a one would assume it's got a fair degree of exposure to infrastructure.
Great. And very quickly, do you have a target price?
I don't have a target price as such. Having said that, year to date, Ashtead has gone up over 29%. I would not be surprised if it continues on its current trajectory, all things being equal and the market being quite good.
Brilliant, Lilian. Thank you very much indeed. We've got loads more questions, but we've run out of time. Damian, back to you. Thank you, Lilian.
Thank you, Lilian. That was an excellent presentation. Much to my annoyance, I held Ashtead for the pandemic and then sold it on pandemic-related fears. And just looking at the share price chart, you can see it's not one of my better decisions. Anyway, up next is Alex Schlich with Tekcapital.
Thank you. So I'm going to talk about Tekcapital. It's a real tiddler. It's a 13 million market cap company listed on AIM, and it's involved in commercializing intellectual property from universities around the world. Two sides. One of them is, as I said, involves in commercializing and working with universities to generate revenue from those businesses. And the other side is well, they actually invest in some of these companies. And to date, they have made 4 investments that they talk about, a 5th one, which is small and they're not mentioning. The key criteria looking to invest in companies where there are large potential markets, and they make sure that they put in place a significant management team with good industry experience. The first company to talk about is Beximco. That's in the area of oxygen technologies. They had FDA approval for a portable oxygen concentrator last year. It's the smallest and the lightest that's going to enter the market. And when that got approval, the company said that they would be seeking a separate listing on AIM. The last time Tekcapital invested in the company, the market cap, the valuation was 9 million. The Times did a piece suggesting that Beximco would float for between 50 million, and that Dowgate was running that. And so we should expect news on that later this year. The other company, running through the other companies, next one is Solarius, which is a food ingredients companies in the area of microsalt. They produce 50% less sodium, so playing to the sort of health vibes that are out there. Very strong management team with experience from the likes of P&G, Clorox, Nestle. And again, this company had last valuation at $1.8 million, and they've been raising money on crowds funding at 5 million. The next company is a company called Lucid, which is a light Bluetooth-enabled eyewear. Some great reviews that make it, I guess, in excess of Bose. So good quality products. Again, they've just raised $1 million through 3,800 investors on Crowdcube. Finally, there's Guidant, and that's in the area of autonomous vehicles, electric vehicles, and land-based delivery drones. Again, a board with experience from General Motors and VW, multiple industry partnerships, multiple patents. And if you look at, I guess, the NAV of the business, the last valuation dates around about May 20 came to an NAV of about 19 pence per share. And if you look at sort of the upgraded valuations, including an uplift to Beximco, if that floats, you're probably looking at about an NAV around about 22 to 25p a share, depending on that. So you can buy pounds for 50p.
Lovely. Thank you very much, Alex. A number of people have asked, what caused the big fall in March?
They raised 3.8 million through the issue of 38 million shares at 10 pence. To be honest, the discount to the then prevailing share price was too high. Probably shouldn't have done it at that price, but they raised money at 10 pence per share, and the share price is, funnily enough, settled around to where the money was raised.
Thank you. They have a habit of excluding shareholders from large placings, resulting in dilution. Do you have any comments on that?
I would agree. It's not a good thing to do, although it's only a small company at the moment. But yes, they have done that in the past. I think the interesting thing this time round is that with the 3.8 million that they've raised, 1.2 is going to be used to fund options in Beximco, leasing 2.4 million. They have a company policy of returning cash on disposal or on exits. Beximco would be the first potential one. So you might think that perhaps the process of raising money or raising equity from shareholders has come to an end, because they've got sufficient cash now and they're about to just start selling some of their businesses, the first one being Beximco.
Thank you. And do you own shares in it?
I do.
Thank you. And how does Tech compare with IPO, i.e. IP Group, and why is Tech a preferable investment?
Well, Tech's trading at around about a 50% discount to its NAV. IP, I believe, is trading at or around its NAV, so it's a discount. I mean, IP Group's a multi-hundred million market cap company. Tekcapital is a 13 million. I don't necessarily think you could compare them. They're different businesses. But if you want to invest in sort of early stage tech companies with a lot of intellectual property, a lot of patents, here's one that gives you exposure to 4 interesting companies.
Thank you. And what's your target price over 1 and 3 years?
I think it's reasonable to expect that the share price gap with the NAV will narrow. The share price is currently 10p, and the NAV is somewhere between 22 and 25p.
And what's the risk of future dilution?
As I said, I think they've raised sufficient cash to support their existing portfolio companies, and the company policy is to return cash to shareholders on exits. They haven't had any exits to now, but Beximco There's been, the company said they were looking for an AIM flotation. The company owned about 24% of that. And so actually, instead of dilutions, you should be getting cash coming back to you.
Lovely. Loads more questions, Alex, but we've run out of time. Thank you very much indeed. Back to you, Damian.
Thank you, Alex, for that excellent presentation on Tekcapital. It looks like a really interesting company. It's a bit high risk for me, but I can really see how it can do well if just one of the investments comes off. Now, coming up next, we've got David Thornton. He's going to talk about Circassia.
The stock is Circassia, which is a stock I own, and I've written about it in the current edition of Growth Company Investor, and I also interviewed the management team last month. Nowadays, it's a single product company. It has Niox, which is the market-leading pheno test for asthma, and it's the only such test which is approved in all the major healthcare markets, and it significantly outsells its rival pheno tests. It's a razor blade business model. The machine costs £845 and consumables are £6 a test. So it's actually a very modestly priced test in healthcare market terms. 90% of group revenues come from repeat sales of those consumables. They carry an 80% gross margin. I think the blended gross margin for the group is 75%. So it's a very attractive business. Asthma is a huge addressable market. There are 340 million sufferers around the world, and fewer than 5% of these have been tested for pheno, which is the biomarker that the Niox test identifies and is a key biomarker in identifying asthma. As I said, it's approved and sold in all the key healthcare markets. The US is Circassia's biggest market, 25% of group sales, followed by China, which I think is about 19%, Japan in the teens as well, and Germany and the UK have 5 or 6% each. Now, there's clearly been a COVID-19 impact on sales last year, lack of visits to clinics and GPs, which is a great shame for the company because it delivered a very strong performance in 2019. Niox sales were up 26% that year to 35 million. And the COVID effect was to whack them down to just below 24 million last year. So hopefully we'll see a strong post-COVID recovery as the world normalizes. Now, costs have been reduced by a new management team, and EBITDA break-even has come down to 32 million turnover. With 75% gross margins, profit should grow very strongly as sales build. There's enough cash to get the company to profitability. Had 7 million at December year end, plus they've raised another 5 million recently. Now, a key element of the story is a new management team. Ian Johnson joined in late 2019 as executive chairman, and previously he'd turned around and sold Bioquell, which made a lot of money for investors. And he's brought in his old CFO from Bioquell, and the COO has had a very long-term career at Pfizer. Now, an important number for everybody is 62.4p, because that's the level at which their options vest. And I think the stock can get there on probably on about a 2-year view. I think December 23, we should see sales getting up into the 40 million region, which would support a valuation, in my view, of north of that 62p level. As I say, new management team and with a single dedicated focus on this Niox test.
Thank you, David. That's tremendous. So why is the quality ranking on Stockopedia only 8, and why do you expect this to change?
Well, there's a backstory which I didn't have time to go into in the pitch, but basically this company came to the market in 2014 and has lost hundreds of millions of pounds. It had a drug in phase 3 trials, which failed in 2016, and the stock went from £3 to £1, I think. The old management team was profligate. They kept raising money, spending it like a drunken sailor. They did a horrible deal with AstraZeneca for some COPD drugs, which the new management team has exited, given the drugs back to Astra and eliminated the historic debt. So they basically cleared the decks completely, and it is now a very different entity to the historic data. That's something which has an appeal to me. And on top of that, Neil Woodford owned 29% of it. So you had an overhang as well. So I think there's lots of things there which people will probably roll their eyes when they hear the name, but it's a completely changed entity now, and very focused on this single product.
Thank you. And are any of the NIOX products susceptible to a near-term patent cliff?
No, not that I'm aware of. The product, NIOX was recognised as a biomarker as recently as 2005. And I'm not sure exactly what year the product was introduced, but I think it'll have only been in the market, well, certainly less than 10 years. So we've got plenty of time to go.
Thank you. And what will be the driver to get Circassia into profit, and when do you think that will happen?
Well, it's sales growth. They did 35 million of sales, I think 34.6 million of sales in 2019. That level of sales now with the reduced cost base will get them into profitability. I should mention as well, there's I think 60 odd million of tax losses that they can utilise. So and there's relatively limited depreciation. So basically, the EBITDA is going to be pretty much dropping right through to the bottom line once we get there. So it's getting that recovery in revenue, which we've lost through COVID and people not going into clinics. And seeing that continued growth. They did 26% growth in 2019, and that was before the new management had got to grips with the business. Going forward as well, there's going to be greater focus on developing distribution partnerships. The old management spent lots of money building internal sales forces. At the moment, 2/3 of revenues are driven by the direct sales. And 1/3 by third-party distributors, and they're really going to drive the distributor model to expand sales rapidly, and they're clearly motivated to get the stock up to 63p.
David, thank you very much. Loads of other questions, but we've run out of time, but thank you. Damian, back to you.
Thank you, David, for that presentation on Circassia. Another interesting company. I can see that asthma medication is going to be big business in the future. And I really hope they do well, considering one of my children does have asthma. And now we have Edmund Shing, who's going to talk about Jubilee Metals. Take it away, Edmund.
Thank you, Damian. Hello, everyone. So, Jubilee Metals, code JLP, it is a platinum group miner. So that is platinum, palladium, rhodium, also chrome and copper, based in South Africa and also Zambia. Market cap 352 million, so roughly the same size as Sylvania, which I know is a Damian favourite. Actually, is also one of my favourites. Stock price currently 16 pence. Stock ranked 85, if you can see it on the screen. I do own it, so I should disclose that, as I also own Sylvania. I like both of them. 8 drivers to mention very quickly. The first one, as it's a platinum group metal miner, like Tharisa, but better than Tharisa in my view. Rhodium represents 62% of the prill split, platinum 20%, palladium 13% at current prices. So the real drivers of sales and profits are clearly rhodium, followed by platinum. Remember that all of these metals are only really mined in any quantity in South Africa or Russia. Secondly, rhodium and palladium are believed to remain in structural deficit as car manufacturing ramps back up as we get back into the sort of post-COVID mode. And thirdly, this is helped by tougher car emission standards, especially coming from China, which is estimated to require 30% more palladium per catalytic converter, and actually does bias car manufacturers to prefer rhodium, as it is much more efficient at stripping out a lot of the toxic waste that we want to get rid of from emissions, like nitrous oxide and others. Sibanye-Stillwater, which is a much bigger competitor in South Africa, actually said in its year-end presentation in February that a supply deficit in rhodium would increase every year from now until 2025. So that's extremely bullish. On top of that, Keelan mentioned the Norilsk nickel problems. This is the world's largest palladium producer out of Russia. The 2 mines that are flooded took out 8% of world palladium production and probably will keep them offline for a very long time. So again, demand-supply balance looks extremely favorable for rhodium, palladium, and platinum. One thing I didn't mention for platinum that is also very important is that it is used in fuel cells. So again, if you like hydrogen power, you're going to need platinum for the catalyzers, for the electrolyzers. And so platinum is not only good as a precious metal, it has this very important renewable energy use as well, potentially. Operating cost for Jubilee is under $500 an ounce for the big 4 PGMs. The basket price currently, as I calculate it, is $3,050 an ounce. So guess what? They are making shed loads of money, more money than they know what to do with. Sales growth should be over 100% for this year, ending June, and for next year in 2022, and another 33% is forecast for 2023. It's very strong sales growth. They have a Zambia copper project they're bringing online as well, which should, again, boost profits and sales at a time when copper prices are very high. And just to finish off, on WH Ireland's forecasts, they've just got net cash, and they could generate nearly 50% of the current market cap in cash by mid-2023 on their forecasts. And they have a target price of 21 pence, which I think is far too low. There are lots of risks, but maybe you'll ask that in a minute. Thank you.
Thank you. So with regard to risk, Jubilee is multi-jurisdictional waste mining. How high a risk tolerance does an investor need to have to own this?
You know the answer as well as I do, Tamsin. Any such miner in a jurisdiction like South Africa or Zimbabwe, like Caledonia, you're going to need a high risk tolerance. Otherwise, don't get into precious metal miners, particularly small ones. Stay well away and stay with bonds or something else if you want a bit of safety. This is not for your grandmother, okay? This is for those with a high risk tolerance. Make no mistake about it.
And what's your projected share price for 1 and 3 years?
WH Ireland's target price of 21 pence is far too low. I would say I'm going conservatively at least double from here and probably more if things go well. If the rhodium and palladium prices stay as high as I think, for as long as I think, then more than a double, I would say, would be my personal target.
Thank you. And if you own Sylvania Platinum, why would you have another miner? Is that not too much in one sector?
Depends on your risk tolerance. I want to make some money. To be honest, to be frank, I really believe that we are in a structural upcycle for precious metals, in particular for precious metals with industrial use as well, and that is silver, platinum, palladium, and rhodium. I think all of them have fantastic demand-supply characteristics right now, and I think the upcycle for demand is going to last several years. So that's why I love Sylvania, don't get me wrong. I still have a very big holding in Sylvania, but I love Jubilee Metals as well. And if anything, Sylvania is the better-known story. If you look at Stockopedia and, of course, the year-end picks, Jubilee is still a little bit under the radar, bizarrely enough.
And if you had to pick one, which would you go for?
Come on, that's like saying, who's your favourite child? You know I can't do that, Tam.
Why
Right
the
now,
large...
Right now,
Yeah,
I would edge towards Jubilee if I had to edge towards one of them. And what I would say, on a chart basis, if it breaks out of 17 pence to the upside, you need to fill your boots.
And why the large director sell?
Well, to be fair, you have to look at the share price of Jubilee. It's come from something like 2.5, 3 pence. So, you know, you can't necessarily begrudge that they take some money to do something with at some point. The management, to be fair to them, have done a great job in turning the company around. It was a loss maker 2 or 3 years ago. So they've done a great job in turning around the prospects of the company, the cash flows, the profitability. They've simplified operations massively and improved productivity and improved the safety record. And all of these things, I think, do deserve a little bit of recompense. So I don't think we can begrudge the fact that they do take some money to spend.
And very quickly, how quickly will their copper production rise?
It should actually start to have an impact next financial year. So actually relatively soon. I mean, it will take a number of years to scale up, but it will start to have a positive impact as of next financial year. So I think that's important. And remember that we do expect to see growth as well in their existing operations, which are a bit like Sylvania's, you know, doing the chrome tailings and picking out the PGMs out of the chrome tailings, which is one reason why big operating cost is so low. And they have plenty of opportunity to expand those operations.
Tremendous, Edmund. We've got loads more questions, but we've run out of time. Damian, back to you.
No, thank you very much, Edmund. You do know how to sell me a share. I'll give you that. I'll take a look at Jubilee and let you know. So coming up next, we have James Nelson, who's going to talk about Beximco Pharmaceuticals.
Good evening. Beximco Pharmaceuticals, ticker BXP, was founded in 1976. Its main listing is on the Bangladesh Stock Exchange in Dhaka. It has had a secondary listing in London since 2005. The company manufactures and supplies generic medicines, primarily to the local market, but also to more than 50 export countries around the world, including into the US. The company describes itself as fast growing, and indeed it is, via a three-pronged approach. Firstly, developing, making and supplying new generic drugs. Secondly, acquisition of smaller competitors and or acquiring individual drugs. Thirdly, geographic expansion via export, through which it can charge a significant price premium versus Bangladesh. Taking a look at the Stockopedia report will further highlight why I like this company. Firstly, as we go down the stock report to the financial summary, please note the forecasts for BXP are from a private broker and should be ignored. Please also note that 2016 was an 18-month year due to a Bangladesh law change on year-end dates. We can see that BXP has grown sales and EPS over the 6 years by a CAGR of 18% year on year. In its latest interim reports for the current year, revenue was up 15.2% and profit before tax was up 32.7%. If we assume this run rate continues for the full year, then reverts to the 18% norm, I estimate the 2-year forward PE is 8 or less, and the 2-year PEG is 0.35 or less. For the current year, why might the run rate continue from the interims? 2 reasons. Firstly, the company had a soft Q4 last year, so making comparatives easier to beat. Secondly, the company is the exclusive distributor of the COVID vaccine in Bangladesh and will be paid for its distribution role. The company have already acknowledged that this is likely to make a material difference to results for the full year ending 30th of June. In summary, all points are BXP is a fast-growing, low-cost manufacturer of generic medicines and has an excellent track record of growth over many years. It's the ultimate sleep well at night GARP stock, as it's cheap, growing fast, pays dividends, and defensive. Fair points may be that shares are non-fungible, so UK shares may always trade at a lower price than the local DACA quoted price. It therefore may always be cheap as well, and it's hard to perceive changes in the investment case due to distance. In summary, I believe BXP remains excellent value and is well worth considering as part of a portfolio. Thank you.
Thank you, James. Given the company is domiciled in Bangladesh, why is it listed in the UK?
It's not, well, it's listed locally and it's a secondary listing in London. So the primary listing is in Bangladesh.
Thank you. Generic drugs are basically commodity products. Why is BXP any better than the other GX companies?
I think it benefits in part from its location. It's one of the lowest cost locations, and that's why it's been able to successfully export to so many countries. So I think it has a low cost advantage. It's grown really fast, and it's been able to really build on the foundations that it's got. Quality manufacturer, fast growing, low cost.
Thank you. And why is its free cash flow so poor versus reported earnings over most periods?
I think this is a part of its growth. So in recent years, it's been expanding its manufacturing facilities. It's been acquiring other companies. It's been acquiring certain drugs. And in fact, just a couple of months ago, it acquired 60% of Sanofi's business in Bangladesh. So I think it's a function of the way the company has grown.
Thank you. And the share price has just broken the floor of an upward trend. How do you account for this?
The strong upward trend was actually triggered by the announcement that the company was going to be the exclusive distributor for the COVID vaccine. I think at the moment, and then it's after announcing that, it then tempered it by saying that the receipt of drugs was taking a little bit longer than expected, which has then put the prices pulled back a bit. However, the benefit will come whether it's in this financial year or next. So I think after such a strong rise on that one particular piece of news, it's then just pulled back a little bit from that.
Thank you. And we should have clarified, do you own shares?
Yes, I do. I've held for 5 years, just over.
Thank you. And is the company exposed to supplier issues relating to workers' rights and supplier chains?
I haven't seen anything in my research to suggest that, but it's a possibility, but I haven't seen any issues so far.
And someone points out that it can't be held in an ISA. Is that true?
Could be. I'm not sure, but could be.
We've reached time. Lots of other questions, but I'm afraid we're out of time. But James, thank you very much. And back to you, Damian.
Thank you, James. Really interesting company. Not one I've heard about before. But yeah, the quality metrics look great. So yeah, I'll take a look. Thank you. So I'm afraid to say we have come to our final presentation. And Jack Brumby is going to round up this evening with Tandem. So let's hope he can get on his bike. Cheers, Jack.
Thanks, Damian. So I recall a couple of weeks ago at the first Stockslam, we got Halfords pitched. So I think it's only fair that I present the second cycling stock on the market that people are aware of, and that is Tandem. It's that said, it is a neglected company. You won't find any broker research on Tandem. I think the market's skeptical about some of the operational progress the company's been making. And I think as a result of that, what we're seeing right now is quite protracted and delayed re-rating playing out over time that still has further to run, in my opinion. So you'll see on that point, despite the 1 year relative strength of around 290%, the company still trades on just 9.8 times trailing 12-month earnings. It's said revenue in the first 11 weeks of FY21 are up 90% year on year. And so that's 11 weeks up 90%. So that's quite a long time frame now, and with a strong order book extending beyond that period. So I think that's good growth for a net cash single-digit PE company. That said, this is an illiquid speculative micro cap. So it's probably worth going through some of the risks up front. I think risk one is there is a historical track record of share price underperformance here. There's no two ways about it. Over a longer term view, there's been quite dramatic re-rating so far, but before COVID, this stock did probably frustrate some of the older holders, and market communication has arguably been poor at times in the past. It's illiquid, it's a volatile microcap. It does have a pension fund, which is reasonably in decent shape. But that said, any one of those things might automatically put it off for some people. So that aside, this is a super stock with a solid mix of ranks. All the quality, value, momentum ranks are in the 70s. Together, that makes a stock rank of 92. It qualifies for 3 guru screens right now. You'll find 1 income, 1 momentum, and 1 quality. So again, speaks to this kind of broad base of factor exposures. In terms of what it does, just quickly, it's not rocket science. It sources products and parts from China. It assembles them at its UK sites, and then it distributes them to national retailers, independent bike dealers, and directly to consumers. So if I just move on to the catalysts in that case, I think catalyst number 1 is the management changes back in February of 2020. This isn't a silver bullet, and there's still work to do, but it is a sign of progress on that front. I think catalyst 2 is the obvious COVID tailwinds we're seeing. You've got good trading in cycling, outdoor leisure products, and golf. That is continuing with everything management has said so far into 2021. Catalyst number 3 is the Freehold acquisition they've just announced. That's going to be built up into a warehouse and fulfillment center, which should allow a ramp up in growth in its Expressco collection of online businesses, which is direct to consumer. And that is catalyst number 4, the sources of longer term growth, with a lot of investment going into the group's websites, the group's e-commerce capabilities, and then other things behind the scenes as well, like enterprise resource planning initiatives that should improve efficiency. So that's it for Tandem.
Jack, thank you very much. Sorry, did you say you hold or you don't hold?
I do hold.
Thank you. And were there any, I know you were up against time, were there any other areas for operational improvement?
I think there definitely is going forwards. I think possibly if you look at the stock report, what you will see is actually Tandem's quite conservative with its cash spend and things like that. It's got quite good returns on capital for the type of business it is, and it doesn't spend too much. And I would say that the online businesses came into the fold around 2015, and if anything, progress has been a bit slow, and COVID really kind of prompted that acceleration. So I think but management is careful, which is good from a shareholder perspective as well. So there's plenty of operational progress that can happen going forwards.
Thank you. And what's your expected share price in a year or so? And is the recent surge just a COVID bounce?
Yeah, so I didn't have time to run through all my risks, but obviously that is another risk that should be flagged, is these COVID tailwinds are more likely than not transitory, at least to a degree. So it would be prudent to factor in some kind of reversion in trade over the next 1 or 2 years. But everything management's saying so far is that trading is continuing to be good. And what I'd like to get across is that there are kind of longer term growth initiatives being put into place that should hopefully continue to progress earnings per share for shareholders.
Thank you. And are there question marks over the remuneration taken by directors?
I think you could argue that. It's definitely something I've heard from other people before, and this does hark back to that point about how there has been a strained relationship with some shareholders in the past, and there's no getting around that. What I have seen is that there is signs that the two sides are kind of coming together, and the business is growing. Are managers paid too much? I mean, possibly, but I also think that there could be a bigger business here if they execute.
And is there any reason for no institutional interest?
I think it's probably a function of the fact that this is a micro cap. When you consider what institutions tend to invest in, it's illiquid. You would, for a lot of funds, they would need to buy a lot of the company for it to be meaningful to their fund. So it's just underneath the radar for institutions, really.
And it's already gone up 280%, hasn't it? Already gone up too much.
Yes. Well, I remember now you asked me for a target price. So I would say, as I said, I think there's probably some skepticism, or it's just neglected at the moment. And there has been a strong re-rating, but that's from an extremely low base. And when you compare it to the metrics we've got now, it's still not expensive. So I think the re-rating that has happened is still happening. And you will probably get profit taking along the way as older holders do take profits. But I would, with a strong year, it looks like, or at least a strong first half of 2021, I see no reason why the shares can't go higher still.
Jack, thank you very much. As always, loads more questions, but we've run out of time. Damian, back to you.
Cool. Well, thank you, Jack. That is one of my holdings I bought quite recently on the back of the new management, really making positive changes at Tandem. So yeah, I tend to agree with you, they're going places. So I'm afraid to say that is the end of the Stockslam, and it really did pass quickly for me. I'm amazed to say we hit 1,600 attendees at one point, which is quite remarkable because in real life it was a struggle just finding 50 people to fill a room. So that's one upside of the pandemic, I guess. Now, I really do hope you all enjoyed the presentation this evening. I've learned a great deal about some new companies, and I hope you have too. So please join me in thanking all the presenters for giving up their time this evening to entertain us and inform us. And remember, if you want to go back over any of the stock pictures again, the video will be up by the weekend, so you'll be able to look at it at your leisure. I would just like to thank Tamsin and Tim from piworld for hosting the event, and Sam from Stockopedia for helping organise things. There's a lot of work that goes on in the back office to make this work, and I think it's been pretty slick, so I'm very happy with that. But we can probably get even better. So if you'd like to give us feedback on tonight's event, that would be fantastic. That will help us out next time. And talking of next time, we do have a date. It is going to be Wednesday, May the 19th at the same time. So please put that in your diary. I think it will be great. Now, if you'd like to present the pros and cons of a stock, I know it seems like a daunting prospect, but every single one of us who's presented had to start somewhere. And Lilian was new tonight and did an excellent job. And really, I think anyone can do this. So please don't be shy. And finally, I'd like to thank everyone in the audience for logging on, joining in the conversation on Discord. Clearly, there wouldn't be an event if you weren't here, so thank you very much. If you fancy continue the conversation on Discord or Twitter, that would be even better. Have a great evening. Thank you.